Guys, in this video, I'm going to show you how to adjust and account for risk in a deal where you're purchasing a commercial building, just like this Dollar General right back behind me, and you don't know whether the current tenant is going to renew the lease. So you're looking at buying a property, you need to know how much to value it at, you've got to account for risk, and you don't know if that current tenant is going to stay in the deal or if you're going to have to find a new tenant. I'm going to show you how to account for that risk and identify the value of the commercial investment. Let's get into the video now. All right, so you're a savvy investor and you need to know how to adjust the purchase price that you're willing to pay for a commercial property based on the risk in the deal. So essentially, we're going to adjust that purchase price for risk. Now, how do you figure that out? How do you know what to pay for a particular property when there's a certain level of risk in it? Well, that's what we're going to cover. You've got a new tenant versus a renewing tenant, okay? So you're in this deal, you're talking with the seller, and the seller's like, my current tenant, I don't know if he's going to stay. His lease is up, and he's making his mind up. So you could have a new tenant on your hands versus a renewing tenant. And we're going to adjust what you're willing to pay for that property and kind of walk through that process for you so you can understand, based on your own investment hurdle rate, what you should pay for that property, adjusting for the risk. Now, the building itself is a Dollar General. It's a 10,000 square foot tenant building for sale. The lease expires soon, and the owner is not sure if the current tenant will renew the existing lease. So I've kind of laid out a model for us here in this chart. Basically, if you have a new tenant, the lease term is going to be for 5 years. The renewal probability of that happening is 50%. We're going to, give us a safe estimate that the building could be vacant for up to 6 months while that agent hunts for a new commercial tenant for that property. So we've got 6 months of vacancy on our hands. That's going to cost something. All right, your market rent for the building is going to be $15 per square foot, and then you're going to have to pay a leasing commission to that agent who hunts down a new tenant for you of 5%. You're also going to have TIs. You're going to have tenant improvements. With your new tenant is going to come those tenant improvements. You're willing to pay $12 per square foot. Now, that's model one. That's scenario one. Scenario two is going to be if you renew the current tenant. Now, that again is going to be a 5-year lease term. There's a 50-50 chance that could happen as well. The current tenant's already in there, so there's going to be no vacancy, which is a huge plus. You've got a $10 per square foot market rent. You're going to be generous. You're going to let him have it a little bit cheaper if he stays in there. And then your leasing commission, you don't have any of that. You don't have to hire an agent because the tenant's already in there, and you don't have any tenant improvement cost. Super cool, right? Now, let's hop into a spreadsheet that I built for us. So let me see if I can find it here. This is not the right one. Where is my spreadsheet, guys? Here we go. All right, let's check this one out. I've kind of played out both scenarios for us. This is your first one with a new tenant. As you can see here, it says new tenant. These are your cash flows, years 1, 2, 3, 4, 5, and 6. This is net operating income. So this is the cash flow that's coming in on the building. This is essentially a 10,000 square foot building times $15 per square foot. Our vacancy is going to be for 6 months out of that first year. We're going to estimate that's going to be half of the net operating income. That's $75,000. And then we have tenant improvements, $120,000 at, basically 10,000 square foot times 10,000 square foot times $12 per square foot is $120,000 that it's going to cost us to get that building ready for a new tenant. Your leasing commission is going to be 5% of this net operating income over 5 years. That is $37,500 you're going to have to pay to an agent for finding you a tenant for that building. And then we've got cash flow year one. We are negative $82,500. Yikes. Every year after that, though, we're making $150,000. Now, you'll see here in year 5, I have calculated the sales proceeds, or the sales price for the building in year 5. You're going to sell it in year 5. That's going to be at a 10% cap rate divided by year 6 net operating income divided by that 10% cap rate. 150,000 divided by 10% is going to give you a value for that property. It's estimated that that property is going to be worth $1.5 million. So in year 6 cash flow, I've put in $150,000 in net operating income plus the $1.5 million sales price of the property, again, based on the cap rate and the year 6 net operating income. Now, we're going to have to take into account the time value of money and the investor's hurdle rate. Now, our investor that wants to purchase this property, he's got a hurdle rate of 12%. So let me kind of walk you through where I got this 1.184 value. All right, so we're going to hop over here. I am a CCIM candidate, as you can see here. So I've basically plugged these figures into my financial calculator. Let me see where I've got this at. Here we go. There we go, guys. Here it is. So I've plugged this into a financial calculator using the CCIM financial calculator, and I have adjusted for the time value of money and brought these cash flows to their present value. So essentially, in year 0, we don't have any cost. In year 1, we have, again, this is the present value of a new tenant scenario. Year 1, we've got $82,500 in costs that we're going to have to pay out as the owner of that building to get it, to basically get it ready to factor in all those things. That's 6 months of vacancy, the tenant improvements, the leasing commission. That's that $82,500 that the cost that we are going to incur. Now, every year after that, we have $150,000 net operating income. And then in year 5, we're assuming that we're going to sell this property for that $1.5 million. With a 12% hurdle rate, that puts us at a net present value of 1.184267. That's scenario 1. Now let's walk through really quick scenario 2. As you can see here, we've got a renewal tenant. Here are the cash flows. Net operating income for all 5 years it's going to be $100,000. That's at that $10 per square foot, as we talked about earlier, because we're keeping the existing tenant in there. He's getting a good deal. There's no vacancy costs. There's no tenant improvements because there's no vacancy costs because the current tenant's going to stay in the property. There's no tenant improvements because we don't have to get the property ready for a new tenant. It's already fitted for him. There's no leasing commission. We don't have to pay an agent to find a new tenant for the property because it's already got a tenant in there. And then let's talk about our resale value. Year 6, net operating income is $100,000. That $100,000 divided by the 10% cap rate gives us a value of $1 million for that building if we sell it in year 5. So our cash flows are $100,000 a year. And in year 5, we have the additional $1 million for selling it. So it puts us at 1.1. This is going to give us a present value at a 12% investor hurdle rate of $927,904. And let's just kind of look at that real quick, guys, on our financial calculator. Again, $100,000 each year. In year 5, we're going to sell it for $1 million, plus we're going to make that $100,000 there at a 12% hurdle rate. Again, the net present value is $927,904. So if I'm buying this property, how do I adjust for risk? I'm glad you asked. Okay, here we go, guys. So we've got the present value of the new tenant at 1.184267. There's a 50% chance that he'll stay in that building. So we're gonna have a risk adjusted value of $592,134. Or we've got scenario 2, which is the present value of renewing the current tenant. That's $927,904. 50% chance that happens. Our risk adjusted value is $492,324. Now we have a total or expected value, if we combine both of these scenarios, of $1,084,457. That is the total value that you should pay for the property, adjusting for the risk in the deal. $1,084,457. Again, at that 12% hurdle rate. That's the most you want to purchase this property for, because you don't know which way the dice is going to flow. Now, just as a quick caveat here, if you were to say that, the new tenant was a better situation, or there was a higher probability, let's say there was an 80% chance that the new tenant was going to stay in the property, it would adjust the value of the actual total or expected value for that property, because 80% of it would be weighted towards this scenario, as opposed to with only 20% weighted towards this scenario. So that is going to impact what the total value is. So if you were 80% sure that there was a new tenant and only 20% sure that you would be renewing it, that value would adjust and change based on the risk level changing in the deal. Now, guys, I get calls and emails from investors all the time looking to invest in the Myrtle Beach market. If you're a commercial investor and you're interested in investing, give me a call, send me a text message, shoot me an email. I don't care if you're 6 months out, 3 years out, 30 days out. If you need someone that can run numbers for you and prepare projections for you, let you know what the return on investment is, take into account the time value of money, and run a series of metrics to make sure you're making a savvy investment decision. Well, guys, you're looking at them. I'm right here, CCIM candidate in our market, in the Myrtle Beach market. Give me a call, 843-360-1737.